Okay, so let's talk about consumer sentiment in America as of April 11th, 2025. There's been a significant shift. The Michigan Consumer Sentiment Index for April has fallen to 50.8, which is the lowest it's been since June of 2022. That's an 11% drop from March 2025 when it was at 57. If you like what you're hearing so far, please hit that like button and subscribe for more deep dives like this. So what's causing this change in sentiment? Well, there are a few key factors that seem to be at play here. Ongoing trade wars, increasing expectations for inflation, and worries about the job market are all contributing. First, let's look at what people are expecting in terms of inflation. The 12-month inflation expectation has hit 6.7%, which is the highest it's been since 1981. And it's not just the short term that's concerning. The 5-year inflation expectation is also up at 4.4%. It's important to know that these increases in inflation expectations are happening across the board, with Republicans, Democrats, and independents all feeling the pressure. Another factor adding to the unease is a growing concern about unemployment. Worries about job losses have risen to levels we haven't seen since the 2009 Great Recession, which is a pretty substantial shift in how people are viewing job security. And this decline in consumer confidence isn't limited to just one group. Republicans have seen their index fall to 81.9, Democrats are at 34.1, and independents are at 46.8. What's really interesting is that all three groups have shown a consistent decline in confidence over the past 4 months. This really points to the fact that these shifts in sentiment are tied to some pretty widespread concerns. Current trade policies seem to be a big factor. President Trump's tariffs on goods from China are at a substantial 145%, and they're also 25% tariffs on products coming from Canada and Mexico. Of course, China has retaliated with its own set of tariffs, slapping 125% on U.S. goods. With all of this going on, it's not really surprising that 67% of those surveyed believe that the government hasn't been successful in tackling inflation or unemployment. Federal Reserve Chair Jerome Powell has said that he thinks Michigan's inflation expectations are outlier data. But even if it is an outlier, the fact that consumers are expecting higher inflation over the long term does pose a potential challenge for the Fed. It's worth mentioning, though, that market-based inflation expectations are still significantly lower, hovering around 2%. We're also seeing some movement in the financial markets. The U.S. dollar has weakened against the euro, hitting a 3-year low. And at the same time, the yield on 10-year Treasury bonds has jumped up to 4.57%, which is a pretty significant 0.53% rise in just a single week. This kind of shift often suggests that investors are moving their money to assets that are seen as safer as concerns about economic stability grow. But it's not just market signals that are raising eyebrows. Leading economists are also starting to sound the alarm. Larry Fink, the CEO of BlackRock, has been pretty vocal about the possibility of a recession, or even that we're already in one. He's pointed to the 4-month 30% drop in consumer confidence and the ongoing trade wars as major reasons for his concern. And all of this economic anxiety seems to be affecting how people are spending their money. We're starting to see changes in consumer behavior. Some people are buying electronics and appliances earlier than they normally would, probably because they're into spending price hikes due to the tariffs. There are also shifts happening in the service sector. Spending on travel and outdoor activities seems to be on the rise, while things like going to the movies or sporting events are seeing a dip. They could be the people are changing their priorities, or maybe they're just more focused on spending money on experiences rather than stuff. President Trump's plan to negotiate new trade agreements with 75 countries in just 90 days is also adding to the uncertainty. Consumers have expressed concerns about these rapid policy changes as how they make it hard to plan for the future. This uncertainty is also having an impact on hiring in some areas. The retail sector, for example, is reporting a slowdown in hiring, and they're directly linking this to the volatility caused by the trade wars. Now, when there's economic uncertainty, investors tend to flock to safe haven assets like gold. Gold prices have surged to an all-time high of $3,220 per ounce, and this is being driven by both the weakening U.S. dollar and the overall economic jitters. It's also important to mention some of the recent trade actions. On April 9th, President Trump announced additional 25% tariffs on Chinese goods, and then on April 11th, China fired back with their own retaliatory tariffs of 125% on U.S. products. What's really interesting is that the consumer sentiment survey we've been talking about was actually completed on April 8th. This means that these latest tariff announcements and the subsequent retaliation weren't fully factored into April data, so we might see an even steeper drop in consumer sentiment when the main numbers come out. These economic developments aren't just contained to the U.S. either, they're having ripple effects around the world. The UK has called for an emergency parliamentary session to address the impact of steel tariffs, and China has imposed new taxes on pharmaceutical products imported from the U.S. Though some economists are predicting a rebound in the consumer sentiment index. They're forecasting a rise to 67 in the second quarter of 2025, then up to 74 in 2026, and 78 in 2027. It was important to remember that these projections depend heavily on what happens with these trade tensions. If things continue to escalate, or even just stay as they are, those forecasts might need to be revised. It's kind of sobering to think that the current consumer sentiment index reading of 50.8 isn't just a new low for the year, it's actually the same level as the lowest point during the COVID-19 pandemic. And it's only a hair's breadth above the all-time low of 50 that we saw back in June 2022. The fact that inflation expectations are climbing could also throw a wrench into the Federal Reserve's plans. With consumers bracing for higher prices, it makes it less likely that the Fed will cut interest rates in June of 2025. In fact, some economists are even suggesting that we might see a rate hike if these inflation expectations keep going up. We've seen times in the past where consumers have stayed pessimistic with the economy, but they haven't stopped spending. But the current surge in concerns about unemployment might change that dynamic. The strong labor market, which has historically been a safety net for spending, isn't seen as the sure thing it once was. Globally, we're seeing reactions to these events playing out in different ways. The European Central Bank's recent inflation data has sparked hopes for a potential rate cut in Europe, and factory data from China and Australia's latest interest rate decision are having an impact on Asian markets. Now, even though President Trump has said that his tariff policy is very successful, the media and the public seem to have a different take. Surveys are showing that around 82% of consumers are critical of the current economic policies. So all of this shifting consumer sentiment mixed with the underlying economic factors we've talked about creates a pretty complicated picture of where things stand right now. It's going to be essential to keep an eye on these trends as we try to navigate whatever changes are coming down the pike. If you enjoyed this analysis, please don't forget to like and subscribe for more in-depth content. Thanks for listening.